You ever stare at a trading chart, right? And you see that perfect indicator setup that happened in the past, and you just think, man, if only I'd taken that trade. Well, today, we're going to systematically answer that what if. We're breaking down indicator backtesting, which is really just the process of turning those gut feelings you get from looking at charts into an actual strategy you can have some real confidence in.
Okay, let's just start here, because this quote, it absolutely nails a feeling every single trader has had. You find this world of indicators, you see the power of a platform like TradingView, and that dream just hits you, right? A perfect automated system. It's like a money printer that just works. It feels so close you can almost touch it. But then, bam, reality comes crashing in. We all turn into Dr. Frankenstein in our little trading lab. We grab a piece of an RSI here, bolt on a moving average crossover there, maybe throw in a jolt of MACD, and we flip the switch, just hoping our creation comes to life. And what happens almost every time? The live market takes one look at our monster and slaps it down, hard. It's like a frustrating universal rite of passage for traders. So, the big question is, how do we get out of that chaotic lab and into a more disciplined workshop? Well, that's our roadmap for today. We're going to start with that money printer dream, then show you a better way by testing the past. We'll walk through a modern 5-step backtest. I'll show you how to actually decode the results, and then we'll wrap it all up with a super important reality check. This right here brings us to the core solution. Instead of just, throwing ideas at a live market and risking your actual money, we can use a structured process to see how those ideas would have performed. Look, this isn't about finding some magical crystal ball. It's about making a huge shift from pure guesswork to finding a real, data-driven statistical edge. So, what is indicator backtesting? Really? Let's make it simple. Imagine you're looking at a daily chart of Bitcoin. You have a theory, like, I bet buying every time the 20-day moving average crosses above the 50 days profitable. Well, backtesting is just the discipline of going back in time on that chart, marking every single one of those signals, and recording what happened next. It's basically a simulation to see if your idea has any merit before a single dollar is ever on the line.
That all sounds great, right? And for years, you could do this stuff manually with a spreadsheet. But man, it was tedious. For the longest time, real automated backtesting was something only quant funds with teams of programmers could do. But as we're about to see, the game is completely, and I mean completely, changed.
Okay, let's get into the practical side of things. We can now break this whole process down into 5 clear, totally manageable steps. And honestly, the most exciting part is that with tools we all have access to now, like TradingView and AI, this whole workflow is open to literally anyone, no coding degree required.
So here it is. Step 1, you form a clear, testable idea. Step 2, you pick your tool, the indicator that's going to give you the signals. Step 3, and this is the revolutionary part, you generate the code. Step 4, you run the test. And step 5, which is where your real work as a trader begins, you analyze the results. You get into those raw trade logs to see if you've actually found an edge.
Now, this slide is so important because it shows the single biggest barrier that has just been completely obliterated. Step 3 used to be this massive wall. You had to learn a complex programming language called PineScript. It stopped like 99% of traders. Today, you can just ask an AI assistant in plain English and it spits out the code for you in seconds. I mean, the democratization of this is an absolute game changer.
All right, so you've run the test. You click a button and suddenly you're staring at a screen packed with numbers, charts, and data. This is the moment of truth. This is where we separate the good ideas from the bad ones. It's time to decode what this data is really telling us.
Your first stop is always going to be the equity curve. It's just a simple line chart that shows the hypothetical growth of your account. See that green line? That's your strategy's performance. And the blue line is what you would have made if you just bought and held the asset over the same period. Right away, you get this visual gut check. Did my idea actually add any value? You also see those dips. Those are the drawdowns. They tell you just how rough the ride would have been.
But hey, that visual check, that's just the tip of the iceberg. The real insights, the real gold, is buried in the details, in the performance metrics. To really see what I mean, let's look at the hard numbers from a backtest that compares a few popular strategies on the exact same historical data.
Okay, so this is where it gets really interesting. We're looking at 4 different strategies here. Now, your eye might jump straight to the final portfolio value, but the metric the pros look at is the Sharpe ratio. That number measures your return for the amount of risk you took. A higher number is way better. And you can see clear as day that the RSI strategy with a Sharpe of 1.44 didn't just make more money, it did it way more efficiently from a risk perspective.
And here's what that looks like in a super simple chart. Look at this. The MACD strategy, it actually made less money than just buying and holding. That's a lot of work for a worse result. But the RSI strategy, it clearly outperformed. This is the kind of objective, data-driven insight that helps you move from just gambling to actually building a strategy.
Now, hold on. Before we all get way too excited and rush off to automate that RSI strategy with our life savings, we need a serious dose of reality. A fantastic-looking backtest is an amazing, essential starting point. But, and this is a big but, it is absolutely not a guarantee of future profits. The past is a guide, not a perfect map of the future. And this quote right here perfectly captures why. Remember our winning RSI strategy? It looks for overbought conditions to sell. But what happens when an asset like Bitcoin enters a massive, face-melting bull run? Well, the RSI can get stuck way up at 80 or 90 for weeks, giving you sell signal after sell signal while the price just keeps rocketing higher. That is a psychological meat grinder that a simple backtest summary doesn't always show you.
So you have to be super aware of the common traps. First up is overfitting. That's when you tweak your settings so they perfectly match the past, which pretty much makes them useless for the future. Then there's ignoring costs, you gotta factor in commissions and slippage, and of course, the big one, the past isn't the future. Markets change, black swan events happen, and finally, you have to make sure you're using the right data, especially for things like futures contracts. So, what's the big takeaway here? The whole point of backtesting isn't to build some flawless, perfect money printer. It's simpler than that. It's to stop being a blind monkey just throwing darts at a board. The goal is to be a slightly more informed monkey. One who runs the test to understand the odds, builds up the confidence to trust a setup, and then throws the darts. It's all about stacking the odds in your favor. Look, backtesting is a journey of discovery. It's going to be full of aha moments, and trust me, more than a few humbling lessons. But it fundamentally changes your trading from a game of hope into a process of investigation. So our question to you is this: which indicator did you test first? And what was the most unexpected thing the data showed you? Let us know. Thanks for tuning in.